Okay, people are starting to come in. Hey, everybody, get everybody in here. Give them a minute or two for people to join. And it takes a couple minutes, and then we'll get going here in about 30 seconds once I see the participants stop clicking up. All right, let's start. Hey, everybody, my name is JP Lee. I'm a product manager at VanEck. I cover emerging market ETFs, and I help with the emerging markets active equity mutual fund and strategy. I'm very excited to be joined today by Angus Shillington, Deputy Portfolio Manager, and Ola El Schwarby, or is it Schwarba? I always get that wrong. Ola is here. Very excited to have them both here. And what we're going to talk about today is India. There's been a lot of news and momentum related to India in the last, I'd say, 6 months to a year. And we're here to dig into why that's happened. And we're going to talk about maybe what's going to happen going forward, or what we think might happen going forward. And then finally, we're going to hit on a couple of options that we have, if you're looking to invest in India. VanEck as a firm, we're very focused on creating intelligently designed, forward-looking strategy. And I think our India ETFs and our emerging markets equity mutual fund and strategies are just that. They're forward-looking. We're trying to tap into growth and potential, and we see a lot of that in India. I'm going to skip this one. So look back over the last 20 years. Ola, thank you very much for being here. Take it away.
Thank you very much, JP, and welcome everyone. So like JP talked about, we wanted to just take a look back at India and what really happened over the last 10 to 20 years to explain the powerful story that India has offered over this period and continues to offer. So if you think about the India story, it has been a pretty powerful combination of favorable demographics, a population that has been largely underserved and where most of the sectors have really been underpenetrated, which offers a long runway for growth. And you've also seen positive policy reforms by the government that have really worked on structurally reducing inflation, broadening the tax base, and improving the government's fiscal situation and revenues to be able to invest in things like infrastructure and both technology related as well as hard infrastructure. And that has resulted largely in financial inclusion as well. And so with that in mind, if you look at the chart on the left-hand side and you look at the lower line, that really shows you a very consistent growth in the GDP over the last 20 years. But what's more interesting for us as investors and stock pickers is that it hasn't just been a positive growth of GDP. You've also seen the market growing or delivering returns at a multiple of the GDP growth, which to us suggests that Indian companies overall have offered shareholder value accumulation and accretion over time. And if you look at the second graph on the right, that's how the progression of tax revenue looked like. This has been a combination of course, your GDP is growing, so your tax base is growing as well. But also there has been a lot of effort over the years done by the government to increase financial inclusion, and with that also formalization of the informal sector in India, and also policy reforms to try and derive more value-added taxes from the different parts of the economy as well, which shows that if you look at the tax growth rate in 2022, that's actually almost 2 times the GDP growth. And again, this is really important because this has enabled the government, to take this money and invest in heavily needed infrastructure improvement, which brings down friction costs, which brings down inflation, increases the ease of doing business in a place like India. And also they've directed a lot of those efforts into upgrading the digitization and technology of India, which has a direct effect on financial inclusion, is very important for the growth of the economy. If we move forward, and take a look at how Indian stocks have performed. I mean, again, we already sort of saw that India has delivered pretty significant shareholder value growth over time. And here we look at it in relative terms compared to the rest of emerging markets, the US and China for the past 20 years. And you can see from the dark blue line, which is the MSCI India index performance, that it has actually outperformed in dollar terms all three of those. And that again speaks quite positively to the story that we're talking about, that the Indian companies and investments specifically have actually delivered positive shareholder returns. And it hasn't just been a top-down story, but also the bottom-up picture and the ability of companies to deliver return on investments, return on equity has been quite impressive over the years, and it paid off in relative performance as well. Next slide, please.
Yeah, let me pause here. I forgot to
Sure.
mention housekeeping. If there are any questions, there's a Q&A. There's a Q&A box, so be sure to put your questions into the Q&A box, and we'll get to them at the end. So sorry, we'll go back to it.
No problem. Thank you. And then the very interesting thing for us as fundamental investors here is if you look at, what underpins this shareholder value accretion, it has really been driven by fundamentals. And so if you look at it, whether in terms of how much your book value per share, which is a representation of shareholder value or shareholder equity value per share, has progressed over time, or how the EPS, the earnings per share, has progressed over time, both of these have been consistently going up. So it hasn't really just been a story of multiple re-rating or stock price growth that's driven by people recognizing the value of India. It really is very well supported by fundamentals, again, due to a variety of factors that we touched on. Part of it is demographic, part of it is like the top-down solid structural growth story. But again, in many cases, the ability of companies and management teams to capture the opportunity and use that in the best interest of shareholders by compounding earnings, by compounding shareholder value. So this is something that we like to see, because as fundamental investors, it makes us quite excited about the story and the growth profile that we're looking at. Now, obviously, this is, as we mentioned, a very good story. It's supported by fundamentals, but at the same time, we have to take a look at valuations of the market. And if you look historically, the market has really, for the most part, traded within a range of multiples between 15 times and 25 times. You've seen some periods in 2008 and during COVID where you've gone outside of this range, due to an outsized risk event or something quite unusual that happened. But for the most part, you've been consistently within this range band. It's not cheap. So if you look at these headline multiples, whether on their own or relative to other EM countries, it does spark the debate around Indian valuations and how to think about these valuations. And from our perspective, we do see that a story like this, where you have a long runway for growth and high visibility on this growth over time, it does warrant a premium. Now, how much of a premium makes sense and how you think about that relative to other emerging markets is something that is widely discussed among investors, and it's also widely discussed among our own team. I think from our perspective, representing the active side of the business, you have to be selective and really think about it on a stock-by-stock basis and see if the risk-reward makes sense. There are some business models that over time are getting disrupted, so even if they're trading at high multiples, that might not be sustainable in the future. There are other stories where we think it's quite consistent growth, quite high visibility, but then you look at the multiples and they're pretty high up there, and it's hard to justify fundamentally. But we do find names like, for example, HDFC Bank, which we've held in our portfolio, and we'll talk about in a little bit, that justify the risk reward, and you've seen very consistent compounding of shareholder value over time, and the multiple is within what we think is a reasonable multiple. So from our perspective, we acknowledge that there is a debate around valuation, and we think that it makes sense for us to be quite selective with how we allocate capital to a place like India, given the good bits that we see, but at the same time also being mindful and conscious of valuation metrics as well. Now, this leads us to HDFC, which is the bank I was mentioning, and a longtime friend in our portfolio, and we've held it for quite a number of years. This is a classic example of a bank that has really, over time, compounded shareholder value. So if you look at basically the green line, that represents the progression of book value per share or shareholder equity per share for the bank. And you look at it, it has been consistently going up over many, many years. And that really has been very highly correlated with the share price performance. So you see that the share price itself has compounded shareholder return over years in a very, very substantial manner. But what we love about the story is it's very clearly underpinned by fundamental shareholder value growth represented by the book value per share. And if you held it for, since 2009 to now, you have gone through some ups and downs within this period, but the trend overall has been very clearly structural growth. And that has paid off, and it has outperformed and given you higher return than both the MSCI Emerging Markets Index and the Indian index itself. So this is one example of an outperformer where management is very focused on growing, particularly within the consumer segment of India, whether that's through mortgage loans, consumer credit, a lot of different high exposure to both the business side and the consumer side, which is at the core of the Indian growth story. And then they've done that in a way where they've compounded returns for shareholders. And we got paid for holding that over time, even if there were some periods within that where you see volatility in the share price. But the trend is very clear. And that's the kind of idea that we love to find and hold on to for the long term. With that, I'll pass it on to Angus to basically walk us through the outlook for India and how we think about the future, given that we've looked at a pretty positive picture in the past.
Great. Hi, everyone. Welcome. Thank you all. That was a great setup. So I think what we'll try and do now is to sort of look at the sort of development trajectory. And I think that broadly we feel like it should be a continuation of the trends that Ola laid out. But there is now a pretty clear change in that arc where you've got government policy and digitization, as you talked about, and we'll sort of bounce through that pretty quickly. But in essence, India is a demand-driven economy, and I think that the issues of the past, which have not obviously stopped the stock market doing pretty well, are this sort of idea of the infamous inefficiencies. So what we're seeing now is a lot of that friction being broken down, and how really that opens up opportunities for public and private investment and outcomes that will probably be quite rewarding. So really just looking at the government policies now, I think this is, we got to break it out into two sides. And the most interesting thing about the government policies is they've gone down first, right? So they create a platform. So tax reform, sort of relatively simple, breaking down something that was very complicated, diffuse, and really wasn't being complied with. So tax compliance up, first of all, and that was the chart that Ola showed you on the first page, but also important because it allows businesses to scale up and become nationally scaled rather than just localized. Then the two financial inclusion reforms, really one, pushing people to own a bank account, which then digitizes their financial transactions. And then the next reform being about pushing credit into all corners of the economy, which of course then results in much more efficiencies, higher margins, and the ability for businesses to invest. Healthcare was a really interesting one, where really just overnight a market for healthcare businesses, healthcare entrepreneurs of almost 500 million people was created. So there again, just a platform to build on top of. And then the last piece, manufacturing growth. And a lot of that is, I mean, this is not the intention to build an export market and become the lowest cost provider. This is very much bringing manufacturing onshore for Indian consumption, Indian brands, Indian fiscal revenues, although there will be exports associated with that as well. So next slide. So what we tried to do here was sort of step back and break down a little of what Ola laid up earlier on a couple of times. The first green line, this is the Indian balance sheet broken down, the Indian government balance sheet broken down into sort of simplified sectors. The attention I draw you to is the horizontal green line. Now that's where we look at the percentage growth of tax revenue. So that's really pocket money for the government. So that's tax compliance, that's growth in business. But at the end of the day, if your tax revenues are going up, it gives you a lot more flexibility with what you decide to do in terms of public investment. So as you say, we see that growing at sometimes multiples of GDP, and when that ends up inside of the government budget, they add another 50% in terms of debt borrowing. So ultimately ending up with 3 or 4 times higher budget to do good stuff. Now, where are they doing the good stuff? And then the vertical green line on the right looks at the areas where specifically the budget is increasing expenditure year over year. And you can see the first 2 lines, transportation and transfer to states, they're both basically infrastructure. Agriculture is an interesting one. And then in terms of investing in the long-term effects of the demographics, education and healthcare, clearly really super important. So on the next slide, we sort of step this out into what does public infrastructure investment look like. Now, what I really thought, and I talked before this presentation, was let's look at this in terms of one, the digitization. So let's look at the soft infrastructure they're building, and then let's take a look at the hard infrastructure. So I think one of the sort of general misperceptions is that India is an inefficient country and will always be an inefficient country. And I think this slide really disrupts that idea. So we now have very high penetration of smartphones and 4 and 5G. That really only rolled out since 2015. But what that allowed the policies to build underneath were, first of all, this identity layer that you could really KYC every customer. So once you know who a customer is, you have access to them digitally, that customer is empowered to do all the stuff, a lot of the patterns that we've seen in the US, so online shopping and by getting short-term credit. It's relatively simple. They then there's a super interesting piece, and this is not private sector, this is public sector. They build a payments layer. So where we have in the US, PayPal, Venmo, these kind of functionalities, UPI, which is the box in the middle on the right, is a publicly owned payments rail. This is free to use. It's super efficient, and really it's just a facility that is offered in public infrastructure to allow entrepreneurs to build. So instead of going out and having to use a Stripe or having to back into one of the other costed payment functionalities, they back into UPI. So really compressing costs. So once you've got the KYC ID layer, everyone's got a cell phone in the hand, the payments layer is effectively free. We move into this sort of data empowerment piece. So a great example is this app called DigiLocker, again, publicly owned, but that allows every person in India who has an identity, which when you see sort of top right, for 1.4 billion digital IDs now, that backs into DigiLocker. So once you're on that app, you have access to your own personal data, which is anything from high school records through driver's licenses, passports, but it also allows at the back end for you to transfer that ID and data to whichever vendor or enterprise that you're using. So the idea is this stuff is layered out in a public investment format and allows the efficiency to be attacked and for entrepreneurs to build on top of it. And the 2 bullet points to the right, what will this cost me if I want to use this stuff? And the answer is just pay your taxes. And that really sort of leads again into the point that Paula made earlier on. And then switching to the next slide to look at sort of the hard infrastructure, the stuff that we're always tempted to look at. And what we've sort of stripped out here was specifically looking at electrification of railroads. So Indian railroads typically fairly backward in the past, but they've really attacked this with the increasing tax revenues. And the first line tells you that they haven't increased, they haven't built any new tracks. The second line and the third line tells you what they've been working on, what they've been investing in is electrification, which on the third and fourth line, sure, they've added a percentage, not a huge amount of percentage to the rolling stock, but what the bottom 2 lines, especially the bottom right-hand green percentage point, is that over the last 2 years, well, 2 years to the end of 2022, what's happened is that the average freight train speed has been increased by 58%. And it's that sort of crazy analogy, you're only as fast as the slowest train on the tracks. They obviously hit scale. But what that tells you is that you can now move 58% more goods, or you can, drop rates by a certain amount. But again, just this hard element of infrastructure, introducing very rapid and very impactful change to allow enterprises, small businesses to build on top of. And on the next slide, what we did here was a very simplistic study, and I'm really going to emphasize the simplistic study. In the green column, what we did was we took year-on-year growth of GDP, and this really connects to the first chart that Ola showed you. Year-on-year growth in GDP compared to year-on-year growth of the stock market. So if GDP was 5% and the stock market grew by 10%, that value would be 5. So what we then did was go back 30 years and take an average of the annual year-over-year value improvement in percentage points of stock market over GDP, and you'll see that it is materially higher in India than most other countries. And again, this talks to value creation by the underlying companies, somewhat higher GDP growth. But taking that multiplier effect and just rolling it over GDP forecasts going forward, we can estimate roughly where we think, I said very roughly, where we think the stock market will be at any given time in the future. And we think that this simple evaluation says that the stock market could, I say could, be the third largest equity market by 2030. So really taking the trends that we looked at earlier on, evaluating those, thinking about the investment trends and the optionality and the opening up of new potential investment through better infrastructure of both hard infrastructure and soft infrastructure, it seems very feasible that those outcomes could result in a much larger equity market, and certainly in a low growth world, it could move it up the rankings quite considerably. So next slide. So really this, trying to tie all this together, where does this as equity investors leave us? And I think the way I would push this simply is that there is a second, third, fourth order effect of all of these public investments, private investments, that mean there's a flywheel going forward that drives multiple new value creating trends over time. So this is not just building infrastructure for the sake of it, spending money to employ people. So let me sort of talk you through how that sequence might look. Railroad costs go down, logistics efficiency goes up. Digitization allows that logistics efficiency to result in much more efficient retail and e-commerce. Increased tax revenues creates more infrastructure, which keeps that feedback loop growing. But as that infrastructure becomes more efficient, you find inflation rates come down, which has always been an issue in India. And therefore, over the longer term, interest rates will come down, improving the affordability for housing. Once you have your house, you watch more media entertainment, you have much more optionality on credit and fintech, and the renewable energy runs alongside of that, providing cheaper power, more power to a much expanded household number. So really just that idea of policy plus connectivity equals success through sort of second, third, fourth order effects of these pretty powerful and fairly effective policies and investments. So moving on. So I think it's really, and we can chat about this sort of generally, known risks for Indian investors. So leadership is always thrown up there as an issue, and I think it's a legitimate issue. So, Prime Minister Modi has been extremely effective over time. Policies broken down a lot of the corruption issues, allowed efficiencies really to flow. Now, this serves the younger group of electorate. The younger group of electorate is growing exponentially with the demographics low, median age of around 27. So, the bottom of the electorate pyramid is younger people. Those younger people like what's going on. So there's more than likely support for him going forward. But even without it, it's unlikely that these policies are going to be reversed. They're excellent policies and they benefit the economy long term. Geopolitical is obviously a big issue right now, which India is sort of in a sweet spot. It's growing, it's large, it's in the Southern Hemisphere, it's outside of the US. It is a favorable partner in the US. It does have these existing benign alignments with China through BRICS. And there are some sort of beneficiaries of reorganization of trade. So net, probably neutral to positive. Ola covered the valuations pretty clear, and I agree with her totally that you have to be extremely selective about where you place investment dollars, whether it's with a thematic ETF or whether it's specifically with an active manager. And in order to capture the trends that we talked about in the first half of the presentation, you need to know that a business is high quality. You need to believe that they continue to compound trends, and you need to be careful not to overpay. And I think that relatively sort of sums that piece up. And then, the global economic slowdown. I think this is really interesting, because I think when we try to engage, or when we engage investors, this idea of a single country fund has become less popular. But I think in the case of India, it's a domestically driven market. It's the reforms are domestically driven. This is very focused on India serving India, India developing with India. There is foreign capital, which is obviously the opportunity that we have, but it is a very powerful long-term domestic story. And although, as Ola showed you in the HDFC slide, there are periods where global risk becomes very compromised, and India will not be immune from that. The longer demographic and structural policy trends are not something that can be disrupted very easily by US rates or US inflation. And I think that really sort of sums that piece up. And Ola, do you want to add anything to those slides? To those pieces?
I think you covered the main points. One thing historically that India was sensitive to from an economic and fiscal standpoint has been the energy prices, so oil prices in particular. Over time, that sensitivity has reduced. So I would say it's probably less of an issue today, but it's something to be mindful of. I mean, if you think oil prices will be much higher for longer, that's something that does impact the fiscal side of India. But overall, I think, when we think about the risks, we have to keep an eye, but in general, it doesn't take away from the strength of the story.
JP, let me throw this back to you. I think we've talked about these trends pretty well.
And then the final trend, which we'll get to a little bit, is that Angus talked about the tech revolution in India has been crucial and really helping to drive growth. So we've gone. First of all, there's a bunch of questions in there, so that's great. Thank you for putting those in there. We'll get to those at the end, and we're going to kind of change gears here and think about how to invest or how to position India in a portfolio. And as of today, we have 3 different options for you if you're looking to invest in India. The first is our actively managed mutual fund, GBFAX, which does have a position in India. It's about roughly market weight, I want to say, matching the benchmark is 17%, something like that. I'm not sure what it is as of today, but roughly matching the market. And then the other 2 options for you are passive ETFs. The VanEck Digital India ETF DGen, which gives you access to companies that are really participating in the digital story there across sectors. And then the India Growth Leaders ETF, which provides access to fundamentally sound Indian companies. So I'm going to hand it back over to Ola to do a little brief overview about what the philosophy of the actively managed mutual fund is and how that's being applied specifically to India.
Sure. Thanks, JP. I mean, like JP mentioned, both Angus and I come from the active side, and we're both on the emerging market equity team. So really, when we think about how to invest in emerging markets, and India is no exception, at the heart of our philosophy is structural growth. And what we mean by that is really trying to find businesses and companies that compound shareholder value over time, whether that's through compounding earnings growth or book value growth in a sustainable and consistent manner. And within that, you might go through business cycles where the market goes up and down, but the actual core delivery of operating performance and shareholder value does sustain through these different cycles. So that's the philosophy that we have. The other part of the philosophy is obviously reasonable price. So I kind of touched on this a little bit before. I mean, India is very clearly a structural growth story, both from as a country and then within the country. A lot of the companies that we look at there, where we have debate sometimes, is the reasonable price aspect. I mean, again, going back to this valuation debate that we mentioned, we have, like JP mentioned, a benchmark, give or take a benchmark weight in India, so about 16% of the portfolio. In an ideal world, given the opportunity in India and the structural growth aspect of it, we would like this to be a bigger position, but obviously we have to pick the right time for entry from a valuation standpoint, and the right businesses that offer what we perceive to be good risk rewards. I mean, Angus said there are elections coming up, so that may create some noise. So maybe that gives us an opportunity to increase our weighting in some companies or find better opportunities. But overall, it's something we're quite mindful of. On our process itself, I mean, we're a fairly tight team, and we are looking at the emerging markets universe. But because we have this very focused approach on structural growth story, and we also really prioritize governance and good governance in companies. So if you kind of strip out companies with poor governance, companies that don't really offer the liquidity that we need, companies that are too cyclical and don't provide this consistent, sustainable, and visible growth over time, that leaves you with a much more manageable set of investable companies for us. Everyone on the team is an idea generator. Typically, we generate ideas through travel, meeting with companies. I spent last month 10 days or so in India just meeting with different companies and trying to find good ideas there. And we come back as a team and we kind of do a preliminary analysis of all the ideas that we find interesting to eliminate any dead ends quickly and leverage the experience and expertise of the team globally. But once we decide that an idea is a good fit, it's structural growth, it is interesting for us, we do a very deep dive into the company. And that really would suggest a 360-degree analysis, whether it's talking to management, of course, but also competitors, stakeholders, consumers, and sell side, and try to get a very good understanding of what we should expect this company to deliver over time in terms of earnings growth, balance sheet growth. And then with that in mind, we come up with what we think is a valuation that is reasonable for the company and an expected return. And we discuss it as a team. If companies are a good fit and the valuation makes sense, they can make it to the portfolio right away, or they can just become part of our focus list, which is really effectively our buy list of companies that we've checked and done the work on. But it's about double the size of what we usually hold in the portfolio, so that we can always have a menu to choose from as markets move up and down, or we want to change the portfolio construction. And then within that, the portfolio is about 60 to 80 names that we own, consistently monitor, reassess over time, and obviously maintain a very strict sell discipline whenever either we see a company being overvalued or potentially a thesis break. So that's our process very quickly, and of course we are happy to answer any questions related to that later. And back to you, JP, for the other products we offer.
Great. So yeah, so that was a great overview of the active strategy. I'm just going to run through these two little ideas pretty quickly. I think we've covered the topic well, but DGIN, ticker DGIN, the VanEck Digital India ETF, gives you access to companies across sectors. So it's not just IT companies, but it's companies that are really participating, driving, and are benefiting from the Indian digital revolution. So there's a discussion about how do we place this in your portfolio, and we think it's definitely part of your growth sleeve. So if you want to add a little bit to your emerging markets growth allocation, this is a great way to access a very targeted and specific area of the Indian economy that we think that we really like and think has some legs for years to come going forward. And the other option is GLIN, which is the VanEck India Growth Leaders ETF. And this is not just tech, right? This is the entire economy. And this is trying to provide access to companies that are essentially very similar to the ones that are in the mutual fund, GARP companies, right? So we're looking for fundamentally sound companies which are exhibiting strong growth characteristics. Now, this slide just shows you, here's the universe of Indian stocks out of there. According to, the factors that go into the market grader analysis, 67 and 68% of them you don't really want to own. And it's according to, their GARP framework. So this is just a way to get access to companies that have good fundamentals and that could and should participate in, the growth going forward. Here's just a little ditty. So it's not just growth, it's also value and then a little bit of quality at the top. That's what's actually feeding the scores for the companies that go into that index. So we're about 36 minutes. I think you've done a great job, gone through a lot of stuff. And I think it's time to go hit the Q&A. We got a couple of good questions. We may skip you. I think some of them are a little bit specific, so we might skip, but I'll answer one really quickly. There was a question, are there ADRs for Indian stocks? And the answer is yes. Some Indian stocks do have ADRs. I don't have a list of them to show you, but they're out there. And here we go. Here's a question for maybe both Ola and Angus. How do you see highly leveraged industries like IT and call center managing? Or how do you see highly leveraged industries like IT and call centers managing global headwinds and the increased financing costs due to rates and other global supply issues? So do you have I think Angus, we've talked about this off channel, but what do you think about IT and call center?
Yeah, I mean, let me first address the highly leveraged piece. Generally speaking, right, there are exceptions. Indian businesses are not highly leveraged, and there are a couple of reasons for that, and a couple of results. The reason one is inflation has been relatively high, and that's now being addressed. So you tend to find rates are relatively high, so borrowing is expensive. Two, there's really very little in the way of bond market, and that is changing quite quickly as well, with the inclusion of the JP Morgan bond index. So first of all, they're not generally that leveraged. The second point, I think, is separately on IT. Now, that appears in our ETFs. It does not appear in our active mutual fund. I think Ola addressed some of the reasons why, but let me just sort of review back. We believe the opportunity in our mutual fund is domestically focused. These IT businesses have been immensely successful over time. And we tend to think about them more as export markets. So they do compete pretty aggressively with the likes of Cognizant, and over time they will probably have some competition headwinds against AI. So we're watching that space pretty clearly. It doesn't fit the scope of our active. It definitely fits the scope of some of our passive. But it doesn't necessarily, I mean, they are Indian businesses. There's a possibility they pivot into providing IT solutions for India. And in that case, there could be a potentially very hopeful story there.
Great. Anything from you, Ola, or is that selling all up?
No, I think Angus covered it pretty well. So
cool.
I'll leave it at that.
This is an interesting one. I'm not sure who would want to answer this, but in the news there's been word of a CBDC, central bank digital currency, going to be issued. I'm not sure if it has been issued or being planned to be issued by the central bank. And how do you see that affecting opportunities for financial innovation in India? And we don't have to. If we don't have a view, we don't have to get into it either.
I think it's look, I mean, CBDCs are on in the headlines right now. I mean, people are very squeamish about them because they sort of cross the line in terms of privacy. So as governments to see exactly what you're doing. At this stage, Indian people are much less squeamish about privacy than the benefits of everything that's going on. So I think there'll be less of an issue. And ultimately, if it was to happen, it would improve compliance and it would improve the reduction of friction of money. So probably net, it's a relatively good thing.
Great. I think last question. Are you looking at emerging industries and emerging markets like commercial aerospace, supply chain providers in India? Is that something that you're focusing on at all? Commercial aerospace, the Indian space race?
yes, there are a bunch of emerging businesses. So that, I mean, that's where the US really is really interesting for India. Certainly in defense and aerospace, there's a lot of cooperation there. Defense is out of scope for us. Aerospace is not yet listed, but it is happening, and it's an area we will be watching very carefully. And what was the other one?
Supply chain.
Yeah, so I mean, supply chain is insanely complex. I mean, to the extent that we're now seeing models that could probably compete very aggressively with UPS, FedEx. The Indian models, and one of the benefits of a sort of last mover advantage is you get to set up business models in software format, software dominant format, where, you know, in the US, they tend to be hardware dominant. And what I mean by that is the sort of FedEx equivalent, which we hold in our portfolio in the active fund, which is called Delivery, is outsourced most of the last mile delivery piece to private contractors, and really only offers itself up as a software optimization and matching tool. Super effective, super efficient. So yeah, and you know, logistics is now driving up to, you know, the guy who runs the shop effectively is communicating through a network of software to the guy on the farm. So very, very compressed. And really, as I said, again, driving down inflation, which has really very powerful knock-on effects.
Great. So last question, I'm going to answer it, and then I think we're going to close. And the question was, is there a primer that you can point us to in order to better understand the Indian stock and bond market? And the answer is not for bonds, but for the economy. We do have, and I guess stocks too, we do have a kind of like a white paper, but it's basically a big blog which goes through 75% of what we went over in this deck. I think it's a great way to kind of get your head around what's happening in India. And it also has a PDF attached to it. So we can follow up with you and email you the link to the blog. So I don't want to, maybe Kendall can do it. She can throw it in the chat so you have it, or we'll follow up after. But the answer is we do have a primer. It is available, and I think it's really good. I think this webinar went great. I appreciate both Angus and Ola, your time and effort, and for being here. Is there anything that either of you want to end the webinar with? Jerry Springer, last thoughts, closing thoughts for the webinar? We don't have to do that, and if you don't,
I mean, just a reiteration for the active strategy. It is a bottom-up strategy. So I know people were asking about specific sectors and different industries. Anything where we see structural growth is going to be within scope. So whether that over time is the commercial aviation supply chain or other things, I mean, we're on the lookout for bottom-up ideas that will deliver those longer-term shareholder values. So it's a, you know, we're not married to one sector, but that's really what we look for every day through, you know, travel and everything else that we talked about. And India we apply the same lens to India. So hopefully as these opportunities crystallize, we'll be there to think about them and capture them.
all right. Well, thanks everybody. Have a great day. It's almost the weekend, I think. No, it's only Tuesday. All right. Have a great weekend. Have a great week, everybody.
Thank you, JP.
Thanks a lot.